Most traders think chart patterns are just shapes, triangles, flags, head and shoulders, lines on a screen. But the real problem is, they trade the picture without understanding the psychology behind it. And this is where accounts disappear. Because patterns are not magic. They are emotional footprints. Fear, greed, hesitation, trap traders, institutional positioning, all compressed into candles. Most traders memorize patterns without ever learning why they form. So they enter too early, exit too late, get trapped in fake breakouts, and slowly begin to believe that technical analysis doesn't work. But the market doesn't care what pattern you see. It only responds to liquidity, emotion, and positioning. And once you understand that, chart patterns stop feeling random and start feeling inevitable. And that changes everything. Most beginners learn patterns like flashcards. If price forms this shape, then price should move here. Simple, clean, predictable. But markets are not predictable. They are emotional battlefields. Every pattern is simply pressure building between buyers and sellers. Nothing more, nothing less. A triangle forms because neither side has full control. A breakout happens because one side finally overwhelms the other. But most traders never realize patterns can fail for the exact same reason they succeed. Because institutions understand where retail traders place entries, where they place stops, where they panic, and where liquidity sits. So sometimes, the pattern itself becomes bait. A perfect breakout can actually be a trap. A fake breakdown can become the beginning of a rally. Because the market's job is not to reward obvious behavior. Its job is to find liquidity. And retail traders often become that liquidity. A chart pattern is simply repeated human behavior. That's it. Nothing mystical. Take a bullish flag. Price explodes upward. Early buyers become profitable. Late buyers fear missing out. Then price pauses. Some traders take profit. Others hesitate to enter. Momentum slows, and the market compresses. This creates the flag. Not because the pattern is magical, but because psychology repeats. Then eventually, buyers regain confidence. New participants enter. Short sellers begin covering, and price breaks higher. The same logic applies to nearly every pattern. Head and shoulders, double tops, triangles, channels, all of them are emotional structures. They reveal imbalance, pressure, fear, exhaustion, accumulation, distribution. The candles are simply the visual language of crowd psychology. And once you stop memorizing shapes and start reading emotion, patterns become far easier to understand. Most traders fail with chart patterns for one reason: impatience. They see half a pattern and assume the outcome. They anticipate breakouts too early, force entries, ignore context, and emotionally attach themselves to being correct. But the market doesn't reward anticipation. It rewards confirmation. This is where revenge trading begins. A trader gets stopped out once, then enters again emotionally, then again, then again. Confidence disappears. Discipline collapses. And suddenly, a simple pattern becomes emotional chaos. Another major mistake is believing every pattern matters equally. But context changes everything. A triangle inside strong higher time frame resistance is completely different from a triangle forming during strong bullish continuation. Professionals understand this. Beginners ignore it, and that difference alone changes profitability completely. Most traders expect patterns to predict the future perfectly, but professionals use patterns differently, not as guarantees, as probabilities. This changes everything. A professional trader understands that even perfect setups can fail, because trading is a game of uncertainty. The goal is not perfection. The goal is consistency. Retail traders search for certainty. Professionals manage risk. Retail traders become emotionally attached. Professionals stay emotionally neutral. Retail traders ask, will this work? Professionals ask, is this worth the risk? That mindset shift is what separates survival from destruction. Because the market will humble anyone searching for certainty. The best traders don't trade patterns blindly. They use a framework. A repeatable process. First, identify trend direction. Second, locate key liquidity areas. Third, wait for pattern formation. Fourth, wait for confirmation. And finally, manage risk aggressively. Simple, but difficult emotionally, because patience feels uncomfortable. Most traders want action. Professionals wait for alignment. They understand. The pattern alone is never enough. Location matters. Volume matters. Momentum matters. Higher time frame context matters. And once all those factors align, execution becomes far more powerful. Imagine two traders looking at the exact same breakout. The first trader enters immediately. No confirmation. No volume analysis. No context. Pure emotion. The second trader waits. They observe momentum. Watch liquidity behavior. Monitor candle closes. And only enter once the market confirms intention. At first, the patient trader feels late, but the impatient trader often becomes trapped. This is one of the hardest lessons in trading. The best entries rarely feel exciting. They feel controlled, calm, calculated, because professionals trade process. Beginners trade emotion. Professional traders understand something most people never accept. Losses are normal. Even great patterns fail. And that's okay, because trading success does not come from avoiding losses. It comes from controlling them. The market doesn't care about ego. It doesn't reward confidence. It rewards discipline. Professionals think in series, not individual trades. One setup means nothing. 20 setups reveal edge. This removes emotional pressure. And emotional pressure is what destroys execution. The calmer the trader, the clearer the decision-making. And the clearer the decision-making, the more consistent the execution. If you truly want to improve with chart patterns, simplify everything. Stop searching for perfect setups. Start studying behavior. Focus on trend, liquidity, momentum, confirmation, risk management, and psychology. Replay charts. Study failed patterns. Study successful ones. Ask yourself, who is trapped here? Who is emotional? Where stop sitting? Where would institutions likely attack liquidity? Because once you begin thinking this way, patterns stop becoming random drawings and start becoming strategic maps. The market begins speaking a different language. And slowly, clarity replaces confusion. Most traders spend years memorizing patterns. Very few spend time understanding people. But markets are people. Emotion, fear, greed, pressure, expectation, and chart patterns are simply the visual record of that psychology. Once you understand this, you stop chasing certainty. You stop forcing trades. You stop reacting emotionally, and trading becomes quieter, cleaner, more intentional, because the goal was never to predict every move. The goal was to understand behavior better than the crowd, and that is where consistency begins.